think we're going to see precious metals continue to move higher. I think the stock market, it may push a little bit higher, but I think it's running out of steam. If the Magnificent Seven weren't so powerful in terms of how much they control of the indices, this market I think would be struggling in a pretty big way. In fact, if we look at the small cap stocks like IWM, and we just kind of look into the more recent price action, this pullback that we had, it was fairly significant. It broke down through the 50-day. It's kind of bounced up, and it's stalling through a lot of price action here. Another one to look at is the microcap stock market. It broke down even more. It's had an even weaker bounce. So money is really changing its momentum. It was pushing into growth stocks a few weeks ago. Now it's really not recovering like it should. We generally want to see small caps and micro caps leading the market higher. And they have kind of broken down into a downtrend. They're now into resistance and showing signs of weakness, yet the Magnificent Seven are still, and the S&P 500 are still looking kind of bullish. I thought the markets were going to top out a long time ago. I kind of always have this perma bear kind of mentality, always looking to be protected and have a game plan for if and when something rolls over. And the reality is the stock market always is going to have a financial reset. So it's not a matter of if there's going to be one. There will be one. We just don't know when, and we don't know what's going to be the trigger to cause it. So I always have this defensive driver kind of mentality. You're always checking your mirrors, looking around, making sure, there's danger all around you driving a car. Well, same with the investment space. There's dangers everywhere. Something could blow up in the financial system, the economy, anywhere. And of course, everything can collapse and fall in value very quickly. So I'm always looking like, oh, this is giving us a warning sign. This could happen. If this happens, we're going to have a huge reset, a huge collapse. So I'm always kind of trying to get people prepared to be mentally, have a strategy in place, because most people won't do anything until things have already sold off and started to collapse. And then, of course, they all have the same mentality, which is like, well, I'm down so much already, and I might as well just ride it out, which could take years, and their price could still fall dramatically from where they are. So I always have this perma bear kind of mentality saying, hey, always be prepared. But again, you got to ride the trend higher. So we've been long the equities markets. We keep riding it to all-time highs. But I'm aware that eventually the music's going to come to an end, and one of these pullbacks in the market is going to turn into the major market top and a multi-year correction that wipes out most retirees' life savings and their lifestyle and all of that. And that's what I try to protect people from.
Most investors underestimate early warning signs. When markets slip, they freeze, hoping losses reverse instead of adapting. But history shows that hesitation ruins portfolios. Corrections can extend for years, especially late in market cycles. What begins as a routine pullback can evolve into a full-scale reversal, especially when concentrated tech leadership masks underlying weakness. Today's environment reflects a classic imbalance, a handful of mega-cap stocks pushing indices upward while broader sectors show fatigue. When leadership narrows, markets become fragile. Preparing a plan before volatility erupts ensures investors avoid the emotional trap of holding and hoping during steep declines.
One of the biggest barometers is really the precious metal space. When you look at gold, well, there's a few things. First off, the stock market is going higher with just a basket of stocks, a handful of technology stocks doing most of the heavy lifting for the S&P 500 and the NASDAQ. But when you go and you look at precious metals, gold is through the roof. We could, there's a really interesting comparison chart. If we share my screen here, I can show you there's two charts that I can share. The left chart is the candlestick chart, is the S&P 500 back in 2007, just as the stock market put in a major top. The yellow line is the price of gold. Now, both of these were rallying together. And when you see gold dramatically moving higher with the stock market, it's a big red flag. Something's wrong. People aren't trusting the financial system. They don't trust the governments. They don't trust the currencies. They're worried about all kinds of things. So when gold starts to just take the lead and run higher, we need to be aware that there's something unfolding that we're not going to like, and it's going to be hard on the economy, probably the stock market. Now, if we take a look at the chart on the right-hand side, we have the same. We've had gold rally for this, last year and a half. We've had the stock market rally hitting all-time highs. The really interesting comparison when we look at these two, now, the market environment is different, like the economic environment, and it always is for every major market top. But this is what I want to share and kind of show where we're at. So I've just added a whole bunch of charts down below. We've got gold miners, we have silver, we have platinum, and we have palladium. And what happens here is we've just, back over here, we started to see a bunch of money pile into gold miners. We saw a bunch of money pile into silver, into platinum, into palladium, and then they all went and had a little bit of a pullback. Now, these are all weekly charts. And this is as the stock market was just putting in a major market top. Gold was pushing to testing all-time highs. And what's interesting is if we were to drag forward, let's just look at the stock market and gold here. Stock market fell about 20%. And gold continued to rally. Gold had this very, very big move. I'll just backtrack a bit here. Stock market put in a top. Precious metals went higher. And if you take a look, you'll notice gold miners down below rallied. Silver rallied like over 50%. Platinum and palladium both rallied over 50%. And then once the stock market momentum really stalled out and the tide actually changed, we saw the stock market collapse and it fell over 50% and it pulled the commodity space down, which generally in a recession, almost everything goes down. And so the same thing happened. All the other commodities sold off 50, 60, 70, 80% during that reset. So if we just backtrack here, Anthony, and look at kind of gold hitting highs, the stock market showing a little bit of weakness, and we look at to where we are today, look at where we are today. We've got gold miners have had the big move, silver. We've seen platinum, we've seen palladium. They've all just recently had the little bit of a pause or pullback, and they're starting to push higher. And of course, that's real. We're getting kind of right into this phase where we could start to see a very big move up in the precious metal space. And this is usually going to be the signal that the stock market is on the cusp of a major market top and selling off. So this is my biggest barometer. When you see the whole world moving away from the financial system and buying physical gold and silver, that is a sign that big money is trying to protect themselves because they see or sense something bad unfolding in the economy. And like the whole world, really, gold is the global barometer. So this isn't just like United States or Canada based. This is gold tells us like something is wrong across the board and people are trying to protect their capital.
Few indicators reveal stress as clearly as precious metals. When gold and equities rise together, it suggests investors are hedging even as they chase returns. Historically, this pattern appeared before major turning points, most notably before the 2008 crash. Today, gold has surged across multiple currencies, reflecting global distrust in governments, debt levels, and inflation policies. Meanwhile, miners, silver, platinum, and palladium have accelerated after brief consolidations, behavior typical before major equity tops. When capital rushes into hard assets while markets sit at record highs, it signals that sophisticated investors are quietly preparing for turbulence the public has not yet priced in.
I think we're going to see precious metals continue to move higher. I think the stock market, it may push a little bit higher, but I think it's running out of steam. If the Magnificent Seven weren't so powerful in terms of how much they control of the indices, this market I think would be struggling in a pretty big way. In fact, if we look at the small cap stocks like IWM and we just kind of look into the more recent price action, this pullback that we had, it was fairly significant. It broke down through the 50-day. It's kind of bounced up and it's stalling through a lot of price action here. Another one to look at is the microcap stock market. It broke down even more. It's had an even weaker bounce. So money is really changing its momentum. It was pushing into growth stocks a few weeks ago. Now it's really not recovering like it should. We generally want to see small caps and micro caps leading the market higher. And they have kind of broken down into a downtrend. They're now into resistance and showing signs of weakness, yet the Magnificent Seven are still, and the S&P 500 are still looking kind of bullish. So this is an early warning sign. You still need to be long equities here. This is still just a pullback, and we just need to see if this is, the start of a new downtrend or if we're going to go higher. And you have to have a game plan to identify when to jump ship and get out of equities if it does roll over the next week or two.
Beneath the headline indices, a different story is unfolding. Small cap and micro cap stocks, often the first to reveal economic slowdown, have been breaking down, failing to recover with large cap giants. This divergence is significant. In healthy bull markets, smaller companies usually lead, not lag. Their weakness implies tightening credit conditions, pressure on consumer demand, and declining investor appetite for risk. Even the seasonal strength typically seen in November and December now depends heavily on a handful of tech leaders. When market breadth deteriorates while gold strengthens, the combination historically points toward exhaustion, not expansion, in the broader economy.
I don't take too much into account. I feel like we have the government shutdown every year, and the markets still kind of do what they're going to do. In fact, if we look at seasonality wise on the charts, we can look at seasonality of gold. So gold's recently pulled back, which is typical in October, November. We usually see gold top out and pull back. And then in the middle of November, which is where we're at right now, gold usually finds a bid and it starts to rally into the end of the year. So that's kind of what we're seeing. If we were to just look over at the gold chart real quick, we can see that. Just get rid of this chart. If we take a look at gold, you can see it topped out in October. It's pulled back, and here we are in November, and it's going to want to naturally move higher up into the end of the year. And it's very similar kind of for the stock market. If we look at the SPY, the SP 500 usually finds a low in October. We had a pretty significant low in October, and it's starting to bounce and move higher. We'll look at the seasonality wise. Usually the stock market gets really volatile in the second half of October, puts in a low, it rallies up, and eventually we go into that end of year kind of holiday rally. And so we're in this phase right now where the stock market's just trying to get some traction, maybe for a few more days before it really has a tailwind where it could push up really strong into December and the rest of the year. So again, I don't really take the whole government shutdown. I don't see it affecting the markets. It's never, I don't find a relationship there. I just really follow price and follow the money flow. And as long as you do that, then you're usually on the right side of the market, because the only way we make money as investors is if we trade with the trend and the trend's going in favor. So you identify the trend and then you jump on and follow that trend, because a trend is more likely to continue than it is to actually reverse. And so many people are always trying to pick tops, and it's a terrible scenario, because the market usually wants to just keep going higher if it's trending up, and the market naturally wants to go higher. Majority of the time it is. So anybody picking tops really has the odds against them. Unfortunately, a lot of people do it because the economic data always sounds bad. It always feels like the markets are ready to pull back, so people pick tops. But it's a net losing strategy, because like 80% of the time, or 95% of the time, the market is going higher and making higher highs. So it's a pretty poor bet for those picking tops.
Long-term bonds remain trapped between inflation concerns and unpredictable policy decisions. Although yields have eased slightly from their highs, the bond market has yet to confirm a durable recovery. Many analysts believe treasuries may need to retest key resistance levels before stabilizing. With inflation proving stickier than expected and global central banks diverging in policy, bonds no longer behave as the reliable hedge they were for decades. Economic data has also become increasingly distorted by frequent methodology adjustments, leaving traditional indicators less trustworthy. In an environment full of mixed signals, relying solely on price and trend can offer clearer direction than headline interpretation.
I mean, when we look at the bond market, like TLT, which is the long-term treasury bond, it's obviously been in a bear market for a long time, since the COVID crash. It's still trying to carve out a bottom. It is in an uptrend, a short-term uptrend overall. It's got a series of higher lows, a series of higher highs. So it's doing okay, but when you look and zoom out of the big picture, it still has a lot of work to be done. I still think it needs to get up to, for example, this ETF, somewhere up into this $100 mark, and it'll probably consolidate. And when it breaks through that, I believe that'll be when, we're going to see bonds really come into life here and become an opportunity. As if bonds get up there, I think the economy will be probably difficult and struggling. It's really difficult, obviously, with what's going on with interest rates and the Fed and the president, all that stuff. What's going to happen with interest rates? Inflation is definitely pretty sticky. If inflation stays up, the rates might not want to really drop. So there's a lot of wild cards. Bonds are definitely not as simple as they used to be. It's not a 40-year falling interest rate environment anymore. Now it's a kind of a mixed interest rate environment. And there's a couple of people trying to push and pull on the rates. And of course, economic data now isn't as true as it used to be. It's the formulas they have for a lot of the economic data comes out, they keep changing them. So for all we know, the data is terrible, but they adjust the formulas to make things look better, right? So we're kind of moving in things a little blind. And that's why one of the nice things about what I do is I don't really care and take any economic data or the Fed or any of that stuff into account. I just simply follow price, follow the money. And if you can follow price action and identify trends that are strong, that are worth getting on board, it doesn't matter what's going on in the rest of the world. You're either long something or you're short or you're sitting in cash waiting for a new opportunity.
Today's tech-driven market resembles past bubbles, though not perfectly. Unlike 2000, many modern tech giants generate enormous cash flows, but the speculative frenzy surrounding artificial intelligence mirrors earlier manias, with capital flooding into companies long before profits appear. Bubbles born from crowd behavior rarely unwind slowly. Instead, they implode rapidly as momentum reverses and liquidity dries up. Some analysts expect the next downturn to resemble 2008 more than 2000, a fast, violent contraction rather than a drawn-out decline. Being prepared means recognizing that trends often persist longer than expected until they don't. When the turn arrives, it could be abrupt.
I mean, we're definitely kind of in somewhat of a tech bubble here. Is it like 2000? I don't think so. The tech companies now know how to make money. They can, they make a lot of money, some of them. The AI space, maybe not. The AI space has a lot of money moving into it. People are dumping investment money in, but they're actually not really making money in a majority of cases. So there is that kind of bubble. I think this time around, the markets move very quickly. I think when things do turn around, there's going to be a lot of selling. I think it'll probably be fairly swift. I think it's a lot like the herd mentality. They all move into the same stocks. Like it's kind of like the big meme stocks that, they just shoot straight up, right? I feel like that's kind of the mentality of the stock market in the AI space. Is everybody's just been moving in at a much slower speed, but lots of people. And when this bubble deflates, it's going to pull things down in a pretty sharp way. I think 2000 was like a 3-year bear market. It took time to unwind. I think it'll be more like a 2008 financial crisis where most of the damage is done over a couple of months. It's severe, it's sharp, it's going to rattle investors and the financial system. So I do feel it's going to be fairly swift and abrupt. And so you want to be prepared for it.